Hey everyone, my name's Andy. My channel's Finding Value. If you like making money, this channel's for you, especially looking into commodities. I really do focus in on commodities. I talk about the overall market sectors as well. Subscribe to the channel if you're interested in that stuff. Give me a thumbs up for the content. Leave comments below if you guys have any comments or questions. I'm going to talk about growth stocks and interest rates and why growth stocks do not like increasing interest rates. And that's exactly what we're seeing and why maybe a lot of these stocks don't like increasing interest rates. I'm going to just give you an example and go over it a little bit. So increasing yields, increasing interest rates or yields changes the way growth stocks are valued, and they really change growth stocks, and I'll tell you why. The majority of the valuation of growth stocks is derived from future growth and ideas and are subject to more risk from yield differences. The higher yields are used to calculate future cash streams to today, which is a net present value. Yields have a large impact on net present value if the majority of your value is being generated in the future and not generated from today in terms of earnings. And I'm going to give you one example. This is a super simple example. All right. I just started, hey, look, if you had 10,000 and you're going to grow this at 10% per year, this would be your cash flow on the left-hand side. This is discounted of the entire cash flow and the net present value of today at a 1% discount rate. So this stream of we'll call it revenue growing at 10% per year is worth $150,000 discounted at a 1% rate. At a 5% rate, it's $118,000. The difference is $31,320 of these two different cash flows based off of the discounted rates of return, 1% and 5%. The percent difference is 21%. Now, it gets extremely large when the numbers almost approach 0%. Because if you go from 0% to 1%, that is a very large difference in your discounted net present value calculations. And you can use that for anything. It could be an inflation rate that you're discounting back. It could be an interest rate that you're discounting back. So all of those have an effect on what you're calculating for a net present value. Now here's the valuation and the time on the bottom. This is the bear trap. And I'm going to show you something on some of these companies coming up. I'm going to show you where that bear trap was in some of these tech companies and how we were at a top and we could potentially be doing this. And you should be looking for a bull trap on some of these companies, not a bear trap. This is going to be a bull trap coming up. First, I'm just going to show you the U.S. Treasury yield and what's causing these moves. If you look at like 2019, right late 2018, it peaked. And I think they did QE. They were trying to push these rates back down again. We had rates dropping, and then we had them really fall out before COVID, which means that the market anticipated COVID happening, at least the stock market sell-off. It was anticipated, and now we're heading back up quite dramatically to the upside. And there wasn't much resistance here. That's why it went up so fast too. So that's what interest rates look like. Here, I've got in the circle here, is that bear trap. We were kind of coming up, came up, and then we had the sell-off. And this is where people are like, oh, well, let's short it. Let's short this thing. It's going down. And then it said, nope, you're trapped in here, buddy. See ya. And it went rocketing higher. And now we're breaking this uptrend line here. We're breaking it to the downside. Interest rates are moving on up. And these high growth stocks, which don't have many earnings today and are all predicated off of future growth and ideas, are going to get absolutely hammered when interest rates go up because of the calculations in the discounted net present value discount rates that I showed you before, just as a simple example. Here's NEO. NEO doesn't like high interest rates or changing interest rates. Neither does the trade desk. That's a pretty steep sell-off from 975 to 634. Neither does Roku. So what we're going to be looking for now, you can see these sell-offs, is we're looking for a bull trap, not a bear trap. This is going to be a bull trap where It's going to come down. It's going to come back up. Bulls are going to be like, it's game on again. And then they're going to get smoked to the downside because we have, I think, a tsunami of inflation coming at some point. I think it's already here. To some extent, it's already here. You're seeing commodity prices go up. You're seeing everything but precious metals is basically going up, which is very weird. How can copper, nickel, platinum was going up? It's now going back down. Beef, poultry, all the other commodities, wheat, grains, doesn't matter what it is, soybeans, all going higher. When those go higher, when people figure out that we have inflation, which they have, bonds will sell off. And when bonds sell off, interest rates go up. When interest rates go up, it's going to spur a rotation of money. You've heard me say this before on the channel. The rotation of money is going to be out of technology. It could be out of some of the other stocks. It's probably going to pull everything down. That's going to be, I think, the bear trap. So I think they're going to correlate like this. This is me speculating. This isn't shown in history per se. I think it's going to create a bull trap in technology stocks and a bear trap in commodities. We're going to pull back. We're going to get a bull trap in technology as it goes back up and then dips back down. It's going to be a bear trap for commodities because it's going to pull down and then we're going to rocket higher. So I think this trap is coming potentially. It's very easy to recognize this stuff looking backwards, very hard looking forwards. So I think that's what's happening. I think it's happening right now in commodities, the bear trap, and we're going to get a bull trap eventually on the technology sector. Obviously, these things are going to be just fine if you hold them for many, many years in terms of technology. It's just the short term. These things are going to come under pressure when interest rates go up. I'm not going to be in them. I like the commodity sector way more than the tech sector at the moment. If you guys like this content, subscribe to the channel. Give me a thumbs up. Leave comments below on what you guys think. Do you think we're in a technology bubble and this thing's about to roll over? Or do you think this is just a short-term little blip where we're going to continue to move on up? Let me know in the comment section what you think. I appreciate you guys listening. This is Finding Value.